Well, good morning, folks. The enemy is trying. He's trying to keep you from learning today. Almost choked to death before I got on here today. And then the audio was acting up. So give me 1 second here. It looks like it's a little too aggressive. Give me 1 second, please. This should be a little bit better. And it is a good morning, despite being a little tardy for reasons outside my reasons and circumstances outside my control. Yeah, I was trying to rush down some bone broth before I got in there, and went down the wrong hole, and then the audio acted up a little bit. So I'm checking Twitter right now. If you all would help me out, if you can hear me, if the volume is good, everything is 5 by 5. Awesome. Yeah, it looks like the title I have. Looks like I put the title on for Friday. Sorry, I apologize. Today is Thursday. You're not time traveling with me just yet. Maybe after November this year, you'll be able to do some time travel. All right, so I got a little bit of a wild hair up my ass yesterday, or whenever it was. I sent a tweet out saying, let's do a workshop. So I usually go on these long-winded Twitter spaces, and I promise we're going to be doing a lot of teaching today. Okay, so if you're here to learn, I promise you, you will learn a lot today. You'll learn about fair value gaps. You'll learn about price delivery. You'll learn about time of day, bias, daily bias, session bias, stops. Where should you look for stops so you don't need a book map or any kind of gimmick out there that requires you to subscribe to something. I'm placing insight in your hands so that way you don't have to have any kind of service whatsoever. All you need is the open, high, low, and close, how to work within the time frames. I'm going to work from the higher time frames down to the lower time frames. I'm going to teach you how to back test today. We're going to be here for a while, okay? I'm not going to be able to promise you a rant won't come in and out throughout this session. So I've allowed 8 o'clock to 11. It might go longer. I don't know. But everything will be recorded. So if you can't stay here for the duration, if you're at work and you're sneaking in here to listen in, shame on you. You're stealing from your boss. I'm not trying to encourage that. I told you to call out. So today we're going to cover a lot of stuff. I'm going to cover Forex. I'm going to cover index futures. I'm going to cover a lot of things that would otherwise be kind of like the first day when in the mid 90s I did one-on-one teachings. And every time I would have a schedule or an appointment with someone, I would tell them what would happen the previous week. So that way, when we would meet on our first session together, I would have everything already in the charts that I already told them the week prior. So everything that I do and have taught for years has always been on the premise of me telling you before it happens, explaining what it's going to do, then we wait for price to do it, and then I can go in and teach more amplified approaches to what it is I already taught you conceptually on this YouTube video or YouTube series, channel, whatever you want to call it, in my mentorship, all those lectures and lessons. If you are looking for that real quick watch, give me something to start studying. If you're new, you don't know where to begin, I kind of like want to place this in the beginning. So give me like 10 minutes of your time. And if you are seasoned and you've been around me for a while, the next 10 minutes is not necessary. So if you want to go grab something to drink, go to the bathroom real quick, use that time here. This part is for the very, very brand new. You've never been here. You never watched any of my stuff, or you've watched a couple of videos and you just feel like this is too much information. Where do I begin? I want to kind of like put this in here because it's also a video that I'm going to refer to in my first book. So there's a lot of things that I'm going to be placing in this channel throughout the duration of 2023 that will help amplify the things I'm going to teach in the book, because obviously books and charts that are static, they're not as dynamic and as good as a teaching tool. Whereas you'll hear and see me do it here, and you also knew on the 13th of this week what I said was going to happen in price action, and it happened. So that way it's not like I'm cherry picking, like you hear people like to say. I tell you exactly what's going to happen, and then we go in and you see how the setups form. So I'm telling you with experience, when you watch my live streams, or if you're watching on Twitter, or if I say something in a Twitter space that leads to my opinion about where I think price is going to go, your task as a student here is to borrow that experience from me. Okay, it's not meant to be a signal service. A lot of you want it, Johnny, on the spot, give it to me right now so I can copy you. That part I don't want to do. But I tell you what it's going to do beforehand. I do it on higher time frame charts, so it allows you enough time to study it. Okay. So where would you begin if you're brand new and you're a little lost in all this information? Go to the 2022 mentorship playlist. There's 41 videos in there. You could probably ignore the first video, if you're really in a rush, but don't skip anything. A lot of people like this to watch the first few and they think they understand it. You don't. So, and you're gonna see that you don't know that, because I'm going to talk about a lot of things with the 2022 model in today's discussion. I'm going to talk about silver bullets, those setups as well. So there's a lot of things here. I got like 2 pages of stuff we're going to cover, and my whole day's open. It depends on how much energy I got. Okay, so I rested well. But you can go right into finding setups and being convinced that there's enough information in that 2022 playlist on this YouTube channel to help you go in, start looking at things and watching right now. Go out there and start looking for setups to practice observing, not trading. Okay, don't think that you can watch it real quick and try to trade with real money. Okay, it's important that you understand you have to slow down your impulsiveness to want to make money. I know it's exciting seeing the things I'm sharing and my students sharing and all these people that are claiming that they found success with my stuff, and that's wonderful. I'm honored. I'm such in a position of privilege to be considered your mentor and having so many people around the world being profitable now. But it's not a rush to get to that point. Every single one of my failed students, and I have them, I don't have just winners, I don't have just success stories. Like anything in life, there's going to be folks that just simply can't do it, or can't do it yet, and eventually they get there. How much effort and time you put into this is going to decide how fast, not that that should be a factor, but how long is it going to take you to find your setup? What is your setup? How do you determine what that is? Because I teach a lot of ways to get into a market. We're going to teach that today too. So this meeting today, this come to Jesus meeting with the ICT content, is really focused on where you should be in your pursuit of learning, what you should be focusing on, and how to determine your path through all this content, because I teach a lot of things, a lot of ways to trade, different time frames to trade, different setups, different entry mechanisms, different ways to take profits, where to take partials, how to take partials. We're going to cover all that stuff today. I'm cramming everything in here as like a nuts and bolt kitchen sink approach to ICT. So that way you can go through today's presentation and determine where your area of study would be best served for your personal interest. So that way you'll hit the ground running, or it'll highlight where you're lacking in your personal study right now. You may be hit and miss, where you make some profits in your demo account and then you lose it and you go back down to break even, but you just don't blow out the account. That's a wonderful position to be in. You may not feel like that is, but it's a wonderful position to be in, because if you're in there impulsively just pushing the button, you're probably blowing your account. You have no idea, no model, no frame of reference to anticipate anything happening in price. And we're going to remove that today. So that way, at least you give yourself a framework to go forward and study, and then you can start measuring progress, which is really important. Because if you just simply watch my videos, and this is the part you need to listen to carefully, if you simply watch my videos or wait for my next video to come out and you're just a viewer and you don't go into your own charts looking for this information, not trying to demo real time, going back and look at old price moves. And we're going to do that today. I'm going to show you exactly what you're supposed to be doing. It's not hard. It's a little bit tedious in the beginning because it feels like it's counterproductive. You're looking at something that's already happened. But everything technical, everything worth doing is always based on studying something as a case study that's happened in the past. How else can you determine a foundation to something? You have to have a good foundation in observing repeating phenomenon at specific times of the day with repeating characteristics. That's what I teach. So those hallmark signatures in price action, that's the whole basis of what I do as a mentor. I'm teaching you how to observe and find that. I don't and I can't promise you profitability. That's something that you're going to determine based on how much time and effort and organization you bring into this. Last point, and then we get into it. If you are lazy, you will fail here. If you have an entitlement mindset where I owe you something, I have to do everything for you, or I can't learn this unless it's one-on-one, or it has to be done live, I'm not going to be a good help for you. I will call moves. I will outline things, watch my live streams. I call every smallest time frame candlestick one at a time, where it's going to go, how it's going to behave. There is no better performance measurement than that. If there is no way of doing that real time, then there's no need for you to ask for statements and give me a live trade and trade live in front of me, because I've already done that. That's in my live streams, and I have a live account with TD Ameritrade. You can actually see statements where I logged in and showed every single day win, loss, exercise of drawdown, came out of drawdown, just to teach students there's nothing to be afraid of. There's no fear of losing. You should respect risk. You will lose trades. Everybody that trades, every single method, every single teacher, educator, everybody, if you're going to put risk in the marketplace, invariably you're going to incur a loss. And you have to accept the fact that that's going to happen. How you handle yourself, how you handle your perception about your ability to work through that and stick to the model that you have trusted, that it doesn't have to be perfect. 100% strike rate is not possible. It's not realistic for you, okay? But you don't need a high rate of return or success rate in terms of trades to be profitable. And I'm not promising you get rich. I'm not promising you millions, but the things that I teach in money management and all those things factored together, can you become wealthy? Absolutely. Can you quit your job? Absolutely. Can you have a secondary income and still keep your job and just treat this as another side hustle? Sure. It's completely scalable to you. Do you want to win competitions? Yes, you can do that too. So it's a matter of what you're doing and why are you trying to trade. And if you're here to try to be the next social media superstar, that's probably not the best way of doing it, because you're going to be impulsive. Everything you're doing is trying to get ahead of somebody else, when it should be just about making sure you don't lose money and that you're working towards learning how to be consistently profitable. And consistently profitable doesn't equate to everyday trading. Day trading is not everyday trading. I promise you, if you try to do it every single day, especially in the first 2 years or so, you're going to have a whole lot more losses than is necessary, which is the reason why I teach with a lot of lectures and the dry parts of my discussions. They're the parts that you're going to come back to after you tried to do this, you made a little bit of money, or you found some success in it, you're hooked now, you want to keep doing it and have more of that experience, and then you have a losing trade, and then you want to hurry up and erase it and fix it. I got to close the day with fixing that loss. Then you make it bigger, and then you start that routine of chasing break even on the day, and all that does generally makes it a larger drawdown. So you want to avoid those periods and be content with, okay, you did something wrong. It doesn't mean everything's broken, but you can derail yourself in your learning Or if you're trying to trade with live funds before you're supposed to, you won't do well. And it makes it harder. So when I teach, I give you 30 years of experience. The things that I'm talking about, I went through it. I lost lots of money, lots of accounts. I did it to myself. Nobody else was to blame. I did every single time. I caused all that. And you have to be responsible with your own actions as well. So if you make money using what I teach you, well done. I'm not responsible for that. If you lose money, well, you did that. Own it. So I'm giving you my experience. I'm proving that I can tell you what's going to happen in the marketplace with a great deal of precision. And you can learn that precision. You can grow into having a very clean understanding about price, what to anticipate, and more importantly, when not to try to trade. That is an important lesson. And not too many people are aware really that that's an important factor in trading. And that sometimes is the boring conversations. But I promise you, once you go into drawdown, you're going to want to listen to those parts in the videos again. And then you're going to wish that you listened and followed the advice I gave you. I want you to do well. I really, really want to see you succeed more so than you do. But there's got to be rules that you have to follow, and you have to give yourself time to grow into it. Okay? So with that mindset and that, I guess, goal in mind, let's begin. After this presentation today, over the weekend, I don't know how much time you have to devote to this today or the next couple of days, but I did a live stream on the 13th of June, and I talked about some of the things we'll talk about in the first hour of the presentation here. I'll do 1 hour, and then I'll break for like 5-10 minutes. I'll leave the recording going, so that way if you have to tend to something, relieve yourself or whatever, I'm going to want to stretch out as well, and then I'll come back. So we'll do that like every hour, like a 5-10 minute break, but the recording will still keep going. For those that are really helpful in their own recording and documentation where I talk about certain things, and I have very studious students that like to do this, if you would help me create a little timeline for if I transition from one topic to the next, or if I go from one market to the next, if you want to send me those minute markers on Twitter, that would be wonderful, and I'll use those in the comment section of the video, so that way it helps people go right to those moments. I am not going to go through this and do that myself, but I know I have a lot of students that do that for their own purposes in my other videos, so just let you know, I'll appreciate that help. But on the 13th, I covered my opinion about what I thought was going to happen this week. And when I was doing one-on-one mentorships back in the mid-90s, folks would learn about me by me advertising, and it was a high-end advertisement. So it was people that had a lot of money and wanted to come to me and learn how to do something with that money on their own, and had either already been in the marketplace or was looking to do something to get into it. So one of the greater selling points I had was I would tell them, much like I did on the 13th of June of 2023, it's on my YouTube. It was live streamed. It wasn't a pre-recorded thing. Everybody watched me outline it. And we talked about the CPI number, and I walked you through CPI real time, and I walked you through a 15-second candlestick chart. So every single candlestick represented a fluctuation of the highest high and the lowest low and open and close of every 15-second increment. Now, you don't see that in books. You don't see anybody teaching with that type of time frame, but everything that I teach is fractal because it's the same price. Whether you're looking at it from a weekly chart, monthly chart, 3-month chart, a yearly chart, it doesn't matter. Price is price. What I'm going to teach you today is a secret of breaking down price and looking for that price delivery continuum. So how to go in, like if you ever watch me do a presentation where I'm recording my trades, if the comment sections are open, or if I share it on Twitter, most of the time you'll see a handful of folks come and say, why did you pick that time frame, and why didn't you trade this time frame, and why didn't you trade that time frame? I'm going to answer that for you today, and that way you'll know what time frame you're going to be looking at. Okay, some of the lessons today won't be so impactful for you because of where you are in your learning. If you're brand new, a lot of this stuff is going to go right over your head. If you stick with this and you study it, I promise 3 months from now, if you come back to this presentation and you watch it, you're going to swear that I added something new. But it's just because your focus is on things that aren't important to you at the time, that I believe are more paramount. And the most important thing is understanding where price is going to go. So the selling point I gave to my students that would come with me one-on-one, they would spend a whole entire week with me, Monday through Friday. And we would be at the charts live when the market opened up. I would show them bonds and S&P. That's it. That's all I would talk about. And I would give them the previous week. I would say, okay, here's what it's going to do. This is where it's going to go to. And we'll cover it next week. Think about that and treat it like what I gave you on the 13th of this week in a live stream. I talked about very specific points of reference in price for the dollar, euro dollar, pound dollar, gold, NASDAQ and ES, and the Dow futures. So I'm going to go through those individually and kind of like, it'll be somewhat of a review, but I'm going to teach also the main takeaways and what you're supposed to do with this information, because it's not like it's unfortunate I get new people all the time on Twitter, and because they don't know me, they don't know my personality, they don't know how to teach. When I show examples, and we'll cover the reasons why I took the NASDAQ trade in detail also for those that are asking from yesterday's trading post FOMC. I'm going to teach you how to trade CPI today. I'm going to teach you how to trade FOMC. I'm going to teach you how to trade non-farm payroll Friday. It's Mythbusters ICT edition today too. We're removing all the talking points that people like to use to detract you from trying to study with me. I teach you to avoid trying to trade ahead of CPI. I teach you to teach you to stay away from trying to trade ahead of FOMC and ahead of non-farm payroll. I have done many examples of me trading post FOMC, post CPI, post non-farm payroll. I've done years of that. My students that were with me every single day in private mentorship for years saw me explain where I think it was going to go and watch it happen. So it's not that I'm trying to prevent you or teach you that no one can make money on those days. It's because I'm assuming when you're watching, you're a new trader, that your experience is very small and you don't know what you're doing. So I'm trying to protect you from yourself, because I was my worst enemy, and you're your worst enemy right now. You don't realize it, but you are. So if you listen to me, I'm trying my best to try to give you everything in the perfect, proper order, how you're going to develop, because I've done this for a long time, and I already know what the questions you're going to ask me. But many of the questions you're going to ask, or that's coming up in normal development, is already in the videos that's on my YouTube video channel. It's layered across lots of time, because this can't be learned real quick. Because you're going to discover what you think you're going into this to try to do, because a lot of you think you want to trade the silver bullet. A lot of you came in think you're going to trade optimal trade entry, but you discovered the 2022 model, and that makes sense to you. So right now, your initial expectations, you're probably going to lose that maybe in this discussion today, and you may develop a better focus on what it is that you want to do, and that's a success for me and you. If you arrive at that today, that's a success. That's a good use of your time today. But I promise you, if you take good notes, not just simply watch me, take good notes. And here's what I want you to do. While you're listening to me today, don't try to write down every single point that I'm trying to cover. When I'm talking about FOMC and how to trade that, or trading CPI, or if I'm talking about silver bullets, fair value gaps, or whatever that topic is, write that topic or focus point and where I am in the minute marker or hour marker on the playback. All you gotta do is hover over top of the little time thing at the bottom of this video, and it'll tell you where you are when I'm talking about it. And it makes it easier for you to go back in and dig into that. That's good note taking, because then you can go back and go in and get the real nitty gritty to it. And I'm going to talk a lot about it in detail. So it's important you do that. Otherwise, watching it alone is not going to be enough. And I know, get to the point. I hear you. All right, so let's go over to the dollar index. All right, and this is a weekly chart. And I shared all this business on the 13th. I added this little area in here. This is a fair value gap. And I have to be careful when I'm talking, because I noticed in the 13th live stream, when I was referring to certain things, my cursor wasn't really where I wanted it to be when I was making points. So I'm trying to make a conscious note of making sure I have my cursor where I want to talk about it. So where I have my cursor now, that candle's high and the specific close is what I'm looking at for that range to that candle's low. Okay, the candle to the left of this one here, that body of that candle that is encapsulated between the range of this candle's low here, that makes the high of the fair value gap. This candle's high or close, and I just dropped it there. It's so close it doesn't make a difference. That candle's high and or closing point represents the low of the fair value gap. The shaded area is highlighting this particular candle's body, not the entire body of the candle, just the range that's being shaded here. Okay, between those two reference points, that is considered, by my definition, I call it a fair value gap. Its classification is a buy side imbalance, sell side inefficiency, meaning that the delivery of price was on the upside. So think about a paint roller. Okay, and I've used this analogy before. If you wanted to paint a wall in your home, and you apply the paint to the roller, and then you apply that roller to the wall, okay, you're getting that delivery up. If you keep doing that from the bottom of the wall to the top, eventually paint will run out, and you'll see these little pockets, these little pits on the wall where paint didn't make its way to the wall. So you already know, what do you have to do? You got to roll back down over top of that to fill in those little pockets of gaps where paint was not distributed. Think about price the same way. Between these two reference points, that being this candle's high and this candle's low, that one candle right here in that shaded area that's purple, there's going to be small inefficiencies in that range that's shaded in purple. The easiest way to simplify it is, we don't need to know yet where those small little pockets are on the lower time frame, because this is a weekly candlestick. So inside that range I'm highlighting here with my cursor, somewhere along the line in that very week of data, there are gaps, inefficiencies. We don't need to know exactly where they are, but we can identify that range right here as soon as that candle closes and we begin a new week. That gap that's shaded in purple, we know that there's a likelihood that the market will want to, at some future time, want to reprice to that. That is not balanced. All it means is that shaded area that's purple, it's buy side imbalance. So the market's shown an imbalance, meaning it wants to go up. It did go up. So what is it inefficient? It's inefficient in the sense that it hasn't had a sell side delivery. Sell side is when price is being offered downward, a down close candle. My down close candles are black. My up close candles or bullish candles are green. for that purple shaded area here, for that to be repriced to and offset the inefficiency of sell side, because it's buy side imbalance, it's imbalanced. It has to be balanced later on, and I'll tell you how it becomes balanced. But right now, what is it lacking? It's lacking sell side delivery. That means a candle must trade down in between the high and low of that purple range. And it's defined by the two candles I mentioned here. This candle's high. That candle's low. So in my mind as an analyst, I'm looking at this and thinking, okay, well, we've seen a lot of back and forth price action all through here. Let me add a rectangle here to kind of like highlight, because I know I may or may not have my cursor exactly where I want it as I'm talking, because of the live stream. Okay, so inside that darker shaded pink area, inside that rectangle, notice how there was a lot of back and forth, up and down price delivery. You see how it's created like a small little trading range in there? Where is there a break in all of that back and forth movement? It's in that shaded purple area here. So up and down, back and forth, think about that paint analogy, all inside this pink area. If price was paint and the canvas that is the background of my chart is the wall, in that shaded area, price has done a very good job of moving back and forth inside that pink shaded area. But it didn't do a very good job of efficiently offering sell side delivery in that little area right there. So what the algorithm does, it seeks those areas there, because it's easily defined by arrays, old highs and lows that are separated across the spectrum of 3 24-hour periods. Any separation between this time frame or any other time frame. And I'm going to teach you the price delivery continuum today, so that way you can see from one time frame down to the smaller time frame, how did you pick that fair value gap and not this fair value gap? You're going to know all that today, okay? But you won't retain it unless you're paying attention and probably watch this video a few times. So we know that there is a strong tendency for the market to want to come back and reprice into these areas. Now let's take us into what I was mentioning on the 13th. For those that you want to go back and revisit, you already watched the 13th video. I think it's a little less than 2 hours long. For the people that want to get right to the point, I'm going to help you here, okay? You should watch the entire video. It's some wonderful information in it, but for those that want to just simply go right to the points, for the dollar index on the June 13th, 2023 price action lecture in market review, I was teaching on CPI, the minute marker 4 minutes. You'll hear me talk about a price level of 102.705. I want you to think about what I just covered here on the weekly chart, okay? I'm going to keep this just as it is here and drop down to a daily chart. So when I'm looking at price, I have all of this higher time frame weekly perspective in mind. So if I were asked, which time frame do I spend the most time on? It's the weekly chart. Now, why do I spend the most time on the weekly chart? Number one, as I taught my students one-on-one in the mid-90s, and the way I teach my students in mentorship, and the way I've taught and shared in those mentorship lectures on my YouTube. Don't buy people pirating my stuff and trying to sell it to you. It's been made available to you on this YouTube channel for free. Go and study it at your leisure. Go at your own pace. There's no rush. I'm not taking the videos down in November. They're staying up. That premise of how I go into the marketplace and what I'm looking for on the weekend, usually either on a late Friday evening once my whole family goes to bed and they've turned down for the night. I don't sleep like a normal person. So I do a lot of study really, really late in the night or early in the morning before they wake up. Or if I don't get that, I do it on a Saturday. I look at the weekly chart in reference to a monthly chart, a 3-month chart, a yearly chart, and I'm looking at it the same way I'm doing here. Okay. And I'm trying not to steal too much thunder from future lessons, but just know that what I'm doing here, I've done that with a monthly chart. I do it with a 3-month chart. And on TradingView, it's really nice because if you go in, if you type 1M, it takes you into a monthly chart just like that. And right away, you can see things that you may not have noticed before. So you have a 1-month chart here, and right away, my long-term students can see right away, they're thinking, wow, that thing used the volume imbalance right there. The separation between this body's close and this body's open. That monthly candle went right up into it there and then went lower all month. So I'm looking at those types of relationships. And you can look at 3M. It'll give you 3 months of data. You can see how we're drawing down into this buy side imbalance, sell side inefficiency, which is the same thing I just highlighted in purple on the weekly chart. That's this here. It's the same thing. So in my mind, I like to look for those first. And if there is no inefficiency, then I'm looking for liquidity. So in summary, let me rephrase everything I just said. When I sit down on the weekends, whatever time I'm going to be doing my analysis, the market is not trading. All of my analysis is done when the market is not trading. What I'm trying to predict, to anticipate, not react to, what I'm trying to predict and or anticipate is where is the present weekly candle reaching for higher or lower prices. If I see an inefficiency like this right here, that purple shaded area, I'm expecting price to try to draw down into that. If this inefficiency wasn't there, I would look for that low because that's where sell side would reside. Or consequent encroachment, which is the midpoint of this candle's tail. So it would be this. Let me make sure I have my cursor sitting here for a second before I start saying anything more. I would either look for that midpoint of that candle's tail, which is consequent encroachment, or I would use the low of that wick there. If, folks, listen, if there was no inefficiency that's shaded in purple, if that wasn't there, I would be expecting price to draw down. Now, why would I expect that? What makes me say that? Because we already hit our targets that I covered in the previous weeks. For those that weren't here, I was talking about how dollar was going to go higher, that we were going to use this shaded area here as an inversion fair value gap, and it would treat it as something bullish to trade up into the weekly order block, which is this opening price of this candle here. This candle's opening price, that's the weekly bearish order block. It was acting as a target. Then I said the mean threshold of that candle, which is the middle point of its body in here. That's the bearish order block mean threshold. That was also a target. So once it hit that, we wanted to see what's going to happen. Once a target's met, whether for the week or a day, you have to get comfortable, grow real comfortable with just simply sitting still and waiting. Move very, very slowly when you're trying to make money. And I learned this lesson from Larry Williams. It didn't make any sense when I first learned it or heard him say it, and it took dozens of times of blowing out accounts, not listening to that advice. Move slow when you're trying to make money. Move fast when you're trying to preserve it or protect it. If you watch something pan out that you have done analysis on and you've been successful with it, don't be in a rush to get another dopamine hit because that feels good. That's a neophyte. That's a brand new trader's trap. You see many times individuals that are open about what they've done wrong and they use social media like a confessional. Father, I've sinned. Look what I did, and I blew my account. Okay? You don't need to do that. Don't do that. Once you see something pan out, meditate on that. Let there be a period of time between where you've seen something pan out, you were successful, and then really record how that felt for you. Because in the future, you're going to have periods where you do something wrong. And it may be a week long of that, a series of doing things incorrectly. And if you don't journal the times that you've done it right, not just when you've done it wrong, but when you do it right, and you encourage yourself and you remind yourself that you followed the rules, the market panned out like you were hoping it would, and you anticipated that, you're conditioning your subconscious to hold on to that as a positive experience. But when you're journaling, you're not recording your negative results in a manner that is condemning. You don't use language or terms like, oh, I was stupid, or this stuff is never going to work for me. Never, ever, ever in your journal, ever record anything negative. You can still highlight the fact that you did something incorrect, but how you describe it, how you encapsulate that in your journal, your subconscious is going to remember that. Because if you write down that you were an idiot in that trade, I should have did this, I knew better, but I did this or that, you're actually creating scar tissue. And there's no elasticity in scar tissue. You can't grow without a whole lot of tearing and pain. So to remove that growth of scar tissue on your subconscious and the psyche that's required to do this as an industry, you have to make sure that you're conscious of what you're doing and you're guarding your mind. Social media is a very big factor in why people are not successful. See, you think social media is going to encourage you, and it might initially, but what you'll find is it's very toxic. And you don't want to bring that toxicity into your journal, because if you put it in your journal, what you're doing is you're making a ledger of every single time that you have an engagement with your expectations, your model, and price. And what price does ultimately is outside your control. But how you perceive what you are expecting and how you record that, that is paramount in how you will walk forward. By recording your negative experiences in a light that is devoid of any kind of judgment, no kind of condemnation, no kind of ridicule or criticism that is harsh. What you want to do is record in your journal if you've done something wrong. Say, I'm happy that I can see that this is where I can improve on. This is my area of study that I need to work on. Versus, I got stopped out here and I didn't listen to what the market was telling me, and I kept trading against it, and I went into serious drawdown, or I would have blew my account there. All that stuff that you're putting into your journal, they're memories, but they're happening in a level that's way deeper than just short-term memory. You're charging it with emotion and energy that you will tap into subconsciously. The effect happens when you're a child and you saw a scary movie. You think every time the lights go off, that event that what scared you in the movie, you think that's what's under your bed. It's in your closet. Okay? Your conditioning is called priming. So when you're journaling, you're priming yourself for future success. It's brainwashing yourself. It's really what it is. You are tricking your brain to only see the silver lining, which is critical. It's critical because it's easy to talk yourself out of this because it's highly technical. And nobody's going to cheerlead you. Nobody's going to coddle you. You have to be able to find your own cheerleader inside you to keep yourself going, because in the beginning stages of this stuff, it's very, very challenging because you don't know where you're going to go as a trader. And we're going to cover more about where you should go and how to determine that for yourself. But you take all this information from a higher time frame. I do this. And I look at where price is likely to go. It's only going to go up for one of two reasons, okay? Price delivery continuum is the movement from where price is right now to future delivery. So where it's going to be 5 minutes from now, a week from now, 2 days from now, 2 sessions from now. It's going up to take out buy stops or it's going up to trade into some kind of inefficiency, like a fair value gap. That is it. That's the only two reasons why price goes up, period. It's not buying pressure. I'm sorry, but that's the truth. It does not go up because of buying pressure. It doesn't matter how many people buy it. Perfect excuse is if you look at price and study volume. Okay? Study volume. How many contracts does it take for a limit up move in wheat? Not that you probably trade wheat. You only need one contract traded. It opens up at a limit up move, boom. Who can trade there? Nobody. It's lock limit. What was the volume? Whatever that trade was that marked it. That wasn't buying pressure. That wasn't buying pressure. It was only one transaction. It opened it up there, boom. Nobody else can buy it. That's not buying pressure, right? So that was the biggest wake up call to me when I was a commodity trader in the 90s. That's how I started, by the way. I realized that volume is important. Yes, it does have a place in analysis, but too much emphasis is placed on that as the reason why price goes up or down, and it's not. Price goes up to seek liquidity. And if it's going up, what liquidity is that? Buy side liquidity, buy stops. Okay. If it doesn't run for liquidity on that particular time frame, it's going up for an inefficiency. That means a gap. A gap would be like that purple shaded area here, or this. I don't know what that color would be called. We'll call it a pale orange. That gap between this candle's low, that candle's low over here, and this candle's high. That's what's being shown here in that little pale orange shaded area that's noted as the weekly inversion fair value gap. That gap and this purple one here, they are called inefficiencies. Think about the paint analogy I gave you. When price is moving back and forth in a defined range, what's the defined range here? Where your eye looks at price, just like I have it shaded here in pink, price has moved rather efficiently inside that pink area, up and down. Okay. When price entered the low end of this pink shaded area, now we don't know that pink shaded area is the range yet. What I'm saying is when I'm looking at price, I'm looking at how price was delivered during a period of time in whatever time frame I'm looking at. So this is applicable to whatever time frame you're looking at, whether it be a weekly chart, a daily chart, 4-hour chart, 6-hour chart, 15-minute chart, a second chart. It doesn't matter. Okay, it does not matter. What matters is where are the inefficiencies and where are the stops. Above old highs is buy side or buy stops. Below old lows is sell stops or sell side liquidity. Those are the two things I'm looking for after my eye goes through the chart and I'm looking for the inefficiencies. So the first thing I'm looking for is inefficiencies. That's the first thing I'm looking for because that's the array that the algorithm reaches for first. It pans for any inefficiency. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. That's what I'm doing on the weekly chart. So for the folks that are hammering themselves and beating themselves up, please teach bias. I just did. But what you're wrestling with is you don't have time looking at charts like I'm showing you here. You see this pink shaded area? How the market entered it, went up to this candle's high. The next week we opened up here. Then we traded higher up to this point here. Then the next candle or next week we open, we trade down and overlap all the way and into the previous high. So there is no fair value gap formation whatsoever in the candle I'm highlighting right now. Notice that? The candle to the left of it's high and the candle to the right of it's low. There is no separation like you see in that purple shaded range. That's a fair value gap. There is no fair value gap between the candle I'm highlighting here with my cursor using the candle to the left and the candle to the right. So what is actually happening there? The price has gone up and down, up and down. That's like that wall being painted very efficiently. Is there any inefficiency there? No. So at that time, when we start on this week, we open, we rally up, make the high, and then we close after making a low here. So there's been a lot of delivery up and down in between the range high of this week and the close of this candle here. Now, why am I picking that close? It's because I'm showing you how prices reacted in here and why I was telling you on the 13th in a live stream that can't be cherry picked. It was told to everybody watching it that I want to see dollar reach lower. Okay. And we haven't even got off the weekly chart yet. I'm teaching what I'm looking at. And this is why I'm trying to tell you, I spend the majority of my time on the weekly chart. I'm looking at how price delivered. Think about what I'm showing you here and how that relates to this area right over here. Think about that right in here. That same idea, we can apply it to over here. I promise you, I'm taking you somewhere. Even though if you think you don't know what your understanding and confusion is probably peaking right now, just keep staying with it. I promise it'll make sense as I'm going. Same thing here. Price opens up, trades higher, back and forth delivery, all up to the high, back and forth, and then we leave it. So before this broke down, is there any inefficiency over here? Below this pink shade there, is there any inefficiency? Inefficiency would be like this candle here. How it has that separation between the candle's high to the left of it and the candle's low to the right of it. Does that occur or form anywhere underneath this pink shaded area in all this? Do you see that? Yes. Right here. I'm just going to use a short little trend line. I promise you folks, this is the stuff you're looking for. Even though you may not feel like it's important right now or it doesn't make any sense, I'm going to take you light years ahead. Most of everybody else out there today. So there's a gap there. So I would take like this rectangle here. I would highlight this, but I'm only showing it as a small little section with the rectangle not being here, but just simply using the trend line sections. So we have an inefficiency here. So when the market leaves this range, it's in a premium relative to the low and where it traded to. It's in this range consolidating, and then it leaves it. Where's it going to go? Well, there's several things. You can use the consequent encroachment of this wick, midpoint of that. Then you have the gap here that this traded down into, but left the majority of the gap still untouched, right? So when it drops here, price is going to want to trade into this area here. Does it do so? Yes. And again, that would be bias. That would be bias for that particular week for the dollar. What do you think that would mean for you Forex traders that want to trade pound dollar? What would you anticipate that week? This week I'm highlighting right here. How would you use that information? You would go into your charts and back test any long positions during the London Open between 2 o'clock and 5 o'clock in the morning, New York local time. You would look at your AM session kill zone, the New York kill zone, between 7 o'clock in the morning and 9 o'clock New York local time. You would look for the model 2022. You would look for optimal trade entries. You could look for silver bullets because silver bullets form in the kill zones between 7 o'clock and 9 o'clock. Ooh, what'd I say? Yep, we're teaching that again today too. It's not limited to just index futures and 10 o'clock to 11 or 2 o'clock to 3 o'clock in the afternoon for index futures. If you're a Forex trader, everything that I teach is applicable. Even though you see me predominantly teaching it in E-mini S&P and futures contracts, it's applicable to Forex. There's subtle little rules that you have to worry about, and time is the factor that's got to be considered. Because yes, there are silver bullets between 10 o'clock and 11 o'clock in Forex, yes, but they are really good ones between the 7 o'clock and 9 o'clock New York Open kill zone, and between 3 o'clock and 5 o'clock, London Open kills in. They're there every day. Every single day, you have a reason for you to find a setup. Now, again, that is not an invitation for you to go in and try to trade every single day. Okay? So I want you to think about how the market moves in these ranges. This is a balanced price range. Why is that a balanced price range? Because the market has moved up and down within it, and then it left the range. So if it's going to leave the range, what is the algorithm? Let's make an argument for the sake of folks that don't want to believe there's an algorithm that controls price and there's no amount of buying and selling pressure that's going to change that. Market's going to go where the market's going to go. It's predetermined. Your daily high and low is predetermined. Whether you like it or not, it is what it is, okay? How can we determine where that likely higher low is going to form, or where would it likely reach to? Starting on these higher time frame weekly charts. And if we know that we can see prices likely to want to expand lower, think about it, because we're on what chart, what time frame up here? Weekly. So my analysis, everything that I'm doing on the weekend, when the markets are not trading, I'm trying to determine what's the strongest directional bias that can be derived by looking at the weekly chart. What is it likely to be reaching for on a weekly candlestick chart? It's going to either be reaching up for buy stops, or it's going to be reaching up for a fair value gap above where the market is right now. If it's likely to go lower, then I believe it's going down to a fair value gap below current market price, or it's going to go down to reach for sell side liquidity below some old low. That is not complicated, folks. These things on your chart, they're not hiding from you. They've been in plain sight. You just never been told to look at it this way because you're trying to apply indicators and all these things. And frankly, when you look at it like this, you should be able to see it really quick. See, when I'm looking at the chart like this, my eye jumps real quick to inefficiencies. My eye jumps to that. My eye jumped to that. That. I'm probably moving faster than the live stream can keep up. And then obviously the gap that I just showed. And every high, every weekly candlestick, high and low, is a factor as well. They're going to be used again. They don't just get used one time and they expire. Okay, so I teach there's a 60-day look back, and the highest form of precision or highest form of accuracy in terms of my key levels, I define it within that 60-day range, and it's 60 market days, not 60 calendar days, obviously, but it's looking back 60 days. So what I'm looking for is the highest high and the lowest low in the last 60 days. I'm looking for inefficiencies in the last 60 days, whether it be premium or discount. That means a fair value gap like that purple one here was. Before we traded down here, in the beginning of the week, the dollar index was up here. And on the 13th, I explained it. I felt like we would draw down. I'm teaching the part that was not made available to you on the 13th live stream. Okay, so I'm filling in that gap of insight that wasn't made available in that presentation, but this is the logic that went behind it. So let me take this off and we'll drop down finally into a daily chart. Okay, so here's the daily chart, and let me take all this business off because they're all distractions, and I want you to focus only on the things that I'm making a point about. All right, so this inversion fair value gap was an old gap. Notice that it does not look like a gap on the daily chart, where it did look like it on a weekly. Let me just, for completeness sake, drop back up to a weekly chart. That separation from this candle's low and that candle's high, the candle to the left of that, it's only sell side delivery. It's a sell side imbalance, buy side inefficiency, SIBI, S-I-B-I. It's a fair value gap, but the classification is a SIBI, meaning that some future time the market is going to trade up and deliver price on the upside. So it's offering buy side delivery. We see that happen here on this candle. But I said that we would treat that as an inversion fair value gap. Go back and look at all the presentations and commentary around that at the time. But on the 13th of this week, June 13th, 2023, I said that we would look for this old gap. Okay, this is what separates me from folks like Chris Laurie, where they look at inefficiency and then he'll tell you it's done. That's his terms. It's done. It's not meant to be disrespectful, but when I tell people you can learn how to read price action with Chris Laurie, if you don't like me, that's fine. But you won't learn what I'm teaching from Chris Laurie. But you can learn how to see inefficiency in price. I didn't learn inefficiency from Chris Laurie. Okay, I was trading before Chris Laurie. But long story short, this whole business of inefficiencies, we can use them as real dynamic support and resistance, because that's in fact really how the algorithm refers back to them. Meaning this, when I look at this range, this shaded area, it doesn't look like a fair value gap on the daily chart, whereas that is a fair value gap. You see that right there? Look where I have my cursor at right here. On this candle here, go up. That candle I'm laying my cursor on top of, to the left of it, that candle's low here. And the next candle to the right of this one, that candle's high. That is a fair value gap. It is a SIBI, sell side imbalance, buy side inefficiency. Notice that that is not what you see inside of the shaded area here. That was the weekly inversion fair value gap. So the price delivery continuum is when you have these higher time frame inefficiencies, regardless of whatever time frame it is, when you drop down to a lower time frame, you cannot ignore or forget the impact that those higher time frame inefficiencies will have on the lower time frame. The lower time frames you can use for precision, like refining risk and making it much smaller so larger positions can be assumed. That's not to say that you should take on larger risk, but let's just say for the sake of argument that you want to use a 1% risk model. That means whatever your equity is in your account, times that by 1%. Whatever that amount is, you can look at a range from where you think you're going to get in at, the entry point, and where you want to define your stop loss. And whatever that amount is, you divide that by the 1% equity that you define as your maximum risk that you want to incur. Having that, the math will tell you how many contracts or lots that you can trade and still be within that 1%. Using lower time frame charts helps you define that risk rather small. I mean, you watched me do it this week where I was using less than one handle on index futures. You cannot do that consistently in Forex. I promise you, you cannot do that consistently in Forex. The reason why is because Forex brokers, many times you're trading inside their specific pool of liquidity. And they have the benefit of being able to open the spread on you. When you're trading index futures, you're seeing the same price everybody sees. Everybody's high is the same. Everybody's low is the same. That's why it's a gentleman's market. In deference to the ladies, that's not a snub against you. It's just a more refined professional market. It doesn't mean that you can't trade Forex and use small stop losses, but don't fall into the trap that you got to do these ultra less than 2 pip, 1 pip stop losses. Because I'm telling you, if I ran a brokerage firm and I was a Forex brokerage firm, I would open the spread all the time on all of you. And I'm teaching you. So wouldn't they want to do it to you? Of course they're going to do it to you, especially if you're trying to trade size and you get frustrated. And when everybody was trading Forex, in the early 2000s, there was bucket shops all the time, and I got burned by several of them, and FXCM was one of them. Okay, and it's just they did it. They did things that were not good, and it's better now, obviously. But I don't ever talk about brokers. So I know some of you are hoping that I'm going to talk about what broker would you recommend. I don't do that. I'm not an introducing broker. It's for you to determine that. Okay, so I'm not in an affiliation with anybody, no brokerage firm, no funding accounts, nothing. And that's the reason why I'm point blank, and sometimes not always the best person to talk about your company, because if I don't like it, I'm going to tell you. But I'm not going to sugarcoat something and say, here, I have an affiliation with this company, I like them. No. Whatever I tell you is the truth. If it's good, I'll tell you. If it's bad, it is. But I'm not trying to tell you to go with any broker. They all suck, and they're all great. It depends on what your personal experience is. So there you go. There's my opinion. But these inefficiencies, these gaps from the higher time frame, you have to have them annotated on your chart. Now, in the future, you'll probably graduate to a point where I have them just on a piece of paper. Like I have a pad. I have a small little yellow pad that I work with all the time. And whatever market I'm following, I have those levels noted. What levels am I talking about? The highest high and the lowest low in the midpoint of every inefficiency on a higher time frame for that particular market. So we're looking at the dollar index. So it obviously is taking me more time to tell you what you're doing with this chart and what you're supposed to focus on and what you're supposed to utilize. But once you understand, it's like riding a bike. You'll go through the motions and it won't take this long to go through it. But the majority of the time, your analysis will be done on the higher time frame weekly chart. You'll be doing these things, looking at where is it likely to gravitate to. Now, rewind back to the 13th of June 2023, earlier in the week. In the live stream, I talked about how I felt that this shaded area here, the weekly inversion fair value gap, would then now act as an inversion fair value gap for the downside. In other words, it would act as resistance. We would want to see signatures in price showing a willingness for the dollar index to go up to it, treat it like a ceiling, reject it, and send it lower. Now, I am not a support and resistance trader. I am not a supply and demand trader. Okay, even though that shaded area may quickly look like, if you're someone that's traded with Sam Seiden's online trading academy and all that stuff, I get accused of using supply and demand all the time. It's not that. Okay, I use very, very specific levels, and they would never consider that gap back there on the weekly chart ever again. They wouldn't consider it anyway, really. But this is what I refer to. That shaded area, that pale orange range, I'm looking at the highest point of it, the midpoint, and the low. There's 3 specific levels there. It's not ambiguous. It's not like here's it's a supply zone. Okay, that's wonderful. Where are you going to trade at? What level are you looking at? So from I guess a grade school perspective, supply and demand may help some of you. Maybe you have been profitable with it, but it doesn't give you a very specific level to trade on. You have to determine where you're going to trade at. So it's like, here, in this general area, let's try to find something that's a buy or sell. What I'm telling you is that the algorithm itself will refer to one of those 3 price levels. Which price level do I use? Which one is it hitting at the time of the day that I tell you to look at it? That's where time comes in. So when I'm teaching you how the algorithm works, how it delivers price. It operates on time delivery. That means every price run is scheduled. Sorry, I know you probably worked in the industry for a long time, and you're probably cussing and laughing, saying this guy's full of shit. I don't see you out here telling everybody where it's going to go before it's going to go there to the infinite degree of precision that I'm showing. So I'm proving you. I can't take you somewhere on a field trip and say, here's where the algorithm is ran from. I can't take you to a place and say, here is where it's operating from. Okay? The only thing I can do is tell you the truth. It is there. It's running. It's delivering price all the time. It's completely manipulated. It's absolutely controlled always. And you shouldn't be fearful of that. You shouldn't be upset about that. You should be thankful that that is an advantage, because once you understand how it operates, you can exploit that. They're not going to change it, because the way that price is offered and how markets are traded isn't going to change. That's never going to change. So there's no reason for you to worry about, oh, this is a fad. It's gonna stop working because everybody likes to use ICT concepts. Folks, this is the market. The markets are, until they do away with the markets entirely, this is going to continue to work. So put that aside. Don't be afraid of that stuff. You're wasting time worrying about things that aren't even a factor. So the 13th of June, I said that I want to look for, and I anticipate rather, the market's going to go up into that shaded area, that's the weekly inversion fair value gap, and treat that as a form of resistance, and then gravitate down to, I said, this very candle right there. That down close candle, I told you, was a bullish order block. It's a change in the state of delivery. That's what an order block is. It's not every down close candle or every up close candle. It's not the things you see people talking about on YouTube either. Many of the things that people are saying about my order block, they're trying to use supply and demand logic, and it's flawed. That's not the same thing. Okay, it's not. I promise you it's not. What's occurring here is at that candle's open, okay, that candle's opening price was the only marker where price can be measured in this time frame where price was offered down. Where was the next down close candle? Right there. So between those two down close candles, if we're looking for a sell model to begin, which is what I was outlining on the 13th of June, where could we expect that to form? The fair value gap that I shaded and I told you on the 13th. It's an old weekly imbalance. So if we leave an imbalance, what was I teaching you on the weekly chart? The market can be efficiently traded back and forth, up and down. Think about that paint analogy. When you paint your wall, are you going to paint up the wall, and when the paint runs out of supply of paint on that roller, you're just going to leave the areas where the paint didn't make it, you're just going to go to somewhere else on another part of the wall? No, you're going to roll right back over top of it. Why? Because you want your wall to be efficiently painted, right? Well, when I look at price, I'm looking at where price has been, where it went to recently, and is there any pockets of inefficiency in there? And because I start my analysis on the weekly chart, why am I starting on the weekly chart? Because the whole weekly range is going to be predicated by what we anticipate on that weekly candlestick. What's it going to do? Is it going to go higher or is it going to go lower? And you only need to determine one of two things. It's going to go up for buy stops above an old high, or it's going to go up to an inefficiency, which is a fair value gap above market price. If it's going to go lower, it's reaching for some inefficiency, which is a fair value gap below price, which is what was being shown here on the weekly chart, but I did not talk about on the 13th, but I told you this candle is the order block I felt it was going to reach down to. And I highlighted that range right there. And I mentioned that there was a likelihood that we would draw down into that after we treat this shaded area up here as resistance. So we can take this idea and dig into the lower time frames and see if there is any signatures that we can look at a lower time frame. We'll look at an hourly chart now. Oh, right away, look at that. So if you look at what we've done, here's the 13th. Okay, so the market wasn't meandering around in here. I said, I want to see price show a willingness to treat this gap here. Let me go up one more time because I want to make sure you're following along. In this little area right here, okay, I'm going to just draw one more rectangle because that way you can see our frame of reference. This high down to present market right there, okay. That shaded area here is this candle underneath my cursor. That day, which is the 12th, from the 12th, and then the 13th is when I gave you the analysis. Okay, I told you it's a live stream. It was not a pre-recorded video. I told you I want to see it. Treat that weekly inversion fair value gap, which is this one here, which is anchored on a weekly candlestick chart. Right now, we're looking at a daily chart. You can track that by looking up here. So the 1 day is a daily. So in this range here, in my mind, I was seeing this delivery of price. This is what I'm anticipating. This is what I'm predicting. I'm not reacting to price. Okay? I see this forming and I'm articulating that in the live stream of June 13th, 2023. So because I have this range now shaded, when we drop down to the 60-minute chart, inside this area here, and I want to scrub that little rectangle over to the 13th, and that would be the perspective. Okay, so what we're looking for is in this area here, did, true or false, folks, okay, you're judging me now. I put out my expectation. I anticipated in this time here, before we close the week, I said later in the week, going into Thursday and Friday, I believe, and I say this in the 13th live stream for the dollar index, I believe that we will likely draw down into this order block, which is that level right there, 102.705, right there. So I'm going to take this box off here so now we can see that. So this is where we're looking at. Did it use, whether you believe there's an algorithm or not, okay, did price use this shaded area as a means to dig into, go up into, and then repel it lower? I mean, I think there's sufficient evidence to suggest that what I was outlining and anticipating, price is doing that, is it not? It did it here. What time of day is that? Look at the bottom of the chart. That's Wednesday, June 14th, 2 a.m. What time of day is that in terms of ICT kill zones? That is the London Open kill zone. That's 2 o'clock in the morning to 5 o'clock in the morning, New York local time. Every single time you look at your time references, it's always in New York local time. I don't care where you live. It's no disrespect to you or where you're at, but the algorithm runs on New York time. The day, the trading day, is not defined by Wellington, New Zealand. Okay, I don't know where this idea came from, but it's straight up New York local time. That's the way it is. Okay, so everything runs on that. And if you keep your time relative to New York, and when your trading view set up here, you can see it's always set to New York. If you do that, you'll know when to anticipate. When to anticipate. When do these moves form? When do they begin? Where do the highs and the lows of the sessions begin and end? Within those time windows I've given you. Now, by itself, just knowing that the high or low of a market in Forex forms in the London session between 2 o'clock and 5 o'clock in the morning, that in itself is a huge advantage. Because if you can have a weekly bias determining that, okay, you know, if we suspect that the dollar index is going to be bearish for the week to come, and forget the economic calendar for a moment because we're going to get into that too. If we think that the price is likely to draw down into these levels here, now I'm going to take that purple shaded area off because that's the weekly fair value gap that I did not mention, but I didn't need to because I took your attention right to that level there, which is the daily bullish order block. A daily bullish order block doesn't always mean it's an entry to go long. It's a draw on liquidity. Okay, it's a PD array that the market will want to reach into. Obviously, you can see that that order block did in fact cause a nice little run up. Where to go up into? Look closely. Where to go into? That same shaded area, that old weekly fair value gap, the inversion fair value gap, dimensioning of it being used as what? Resistance. So in here, we're talking about it. It's likely to go up. We're going to see it treated as resistance. Does it? Yes. Does it go down to the level I talked about on the 13th as a draw on liquidity or target? Yes. Then what does it do? It repels price higher again. And it goes into what? Look at these three up close candles right in here. See all that? Listen close. ICT, why do you use the last candle on some examples and other times you use the consecutive candles? Well, all of these are inside of this fair value gap, that shaded area, which is an old weekly fair value gap. If they're consecutive like this and they're inside that range, I'm going to use the entirety of all of that because the beginning of this opening on this candle here and the next candle and the next candle, that's all one price delivery for buy side. It's delivering buy side delivery. So that means there's movement up. So I want to refer back to that opening price right there because that starts the order block. And the mean threshold would be the middle of the low of this candle to the high of that one. And that would look like this. So we have the low of this candle up to the high. Mean threshold is 103.324. Okay. So we allow, listen folks, we allow for price to trade to and through, but not close, listen, not close above mean threshold. So the wicks do the damage, the bodies tell you the story. Look what's going on over here. See all that? We'll get to that in a second. Opening price, let me drop this here. It hits differently when you know I've already talked about it beforehand, huh? Oh man, I can't use a cherry picking analogy on it now. So here's the mean threshold, so that's what I'm identifying here. But this level, that opening price there, that is the change in the state of delivery. Meaning, on the 13th of June, I stated that I want to see, you want to study, if I have any validity behind these things, if it's not going to hold up, if it doesn't react the way I'm talking about in the future, then there is no algorithm. That means that I'm a fraud. That means that there's none of these things should be even studied because it's all hindsight. Okay. So what I do is I tell you in the analysis where I think price is going to gravitate to. And then you as the student, you go back through price action and you look for what PD array you like. What does that mean? What's that mean? What do you use for your setup? What's your multiplier? Is it the optimal trade entry? Is that what you use to get into a trade? Do you use a fair value gap now? Do you use the 2022 model as your trade? Do you use breakers? It depends on what you feel comfortable trading with. There is no better PD array than another one. Because not every single price run will have every single one of my PD arrays in it. Not every single price move that I'm trading has a breaker in it. Not every single one of the trades I'm entering is using a fair value gap. Not all of them are an order block entry. Not all of them. Well, when's the last time you see me talk about an optimal trade entry? But you probably still trade them, right? I'm teaching you a wide spectrum of opportunities for you as the trader to gravitate to whichever one makes the most sense to you. All of them are equally profitable. All of them are equally capable of blowing your account if you misuse them. So I'm a realist. I have 81 ways to get into a marketplace. You don't need but just one. You just need one. And whatever that one is, you stick with it until you get really, really good with it. And then once you find consistency with it, if you want to graduate into something else and dabble into trying to build another model in addition to the one you find consistency and profitability in, have at it. But don't try to apply all of them. That's what everybody does wrong when they come to my content. They try to apply everything to every single market condition, and that's not what I'm teaching you to do. Now, if you go to Tom, Dick, and Harry's Dollar Menu Mentorship, where they take my stuff, rebrand it, and try to condense it down to a 5-minute trainer video, that's the perspective you're going to get. You're going to get a watered down approach to what it is I'm teaching, and you're not going to come to the real understanding of what it is that's available to you. These consecutive up close candles is one order block, meaning that inside this shaded area, right before this market changed and went lower, my eye goes right to that opening price because I'm using all three of these candlesticks because it's inside of a range. I've already told you on the 13th, we want to treat that range as a inversion fair value gap. In other words, it's an area where the algorithm will go up, spend some time in there, allowing smart money, traders that will see what I'm teaching you that isn't in books. They're using this frame of reference because they want to sell short here and buy at a lower price down where the order block is here. An order block is not orders. You can't see an order block the way I'm telling you. You can't see that on level 2. There's people that say, oh, level. It's not level 2. It has nothing to do with the orders. It has nothing to do with it. Nothing. Okay? So stop the bullshit. It's where the market changes its state of delivery, meaning that inside this shaded area, We want to see the price go up into it. Does it do it? Yes. And then once this candle's opening price, that is the beginning of these 3 consecutive candles, and I'm using all 3 because it's inside the area I told you to define as the reason to anticipate price going lower from the beginning, right? On the 13th of June, I said, we want to see signatures. That means evidence in price delivery, in price action itself. Does price show a willingness to treat this shaded area as resistance? Does it want to send price lower when it enters into it? Where? The low, midpoint, consequent encroachment, and the high. We don't want to see the high end of an old fair value gap if it's being treated as an inversion fair value gap. The better setups form if the high, if you're looking at it as a resistance or using it as the beginning point or inception of a sell side delivery or sell program, we don't want to see the high traded to. Treat that like the same thing I treat a breakaway gap, which is a fair value gap that won't completely fill in. If it gives you that signature, which is what we're seeing here, as soon as price breaks below the opening price here and leaves the shaded area that's in like a pale orange, once it does that, that qualifies that right there as a bearish order block. Why? Because the state of delivery changes from buy side delivery, then it crosses over the opening price there. Just because it crossed below an opening price of a series of up close candles doesn't make it an order block. The narrative behind where that order block resides, that is the imperative point that everybody is missing. That's why everybody that has books and bullshit out there they want to call mentorships and courses talking about this is an order block. You have no idea. You're making shit up. You're making it up as you go. You're on the fly. You're looking at something in hindsight, trying to explain something. In this shaded area is what I told you to look at it on the 13th. And then we look for signatures inside that range. What does that mean? Well, you have an order block here. You also have a breaker. What? There's a breaker there. High, low, higher high. Consecutive down close candles. Same thing we're applying here. All these ranges here, push it forward in time. You're getting the same entry here. Stop above here. We're not trading the dollar index, but I'm trying to tell you that you can pick your own model, and every one of you can be trading differently using what I've taught, and you're all can find profitability. You don't need the same entries. The entries are the least important thing. I'm going to say it again. Where you enter is the least important factor in consistency. It is the least important thing. You have to know this. Where is it going? Because if you can determine where it's likely to go to, and what I've outlined here in this beginning of this presentation today, you can find a myriad of entry points. When price returned back up into this low here, right there, you can be short. What would you anticipate? This rejection block, which is the lowest down close, that's your first draw. Below it, sell side. And then you can start doing projections on all this price run here, lower, to see if it wants to dig in lower. It's Friday. It's already hit the mark here that I outlined and called for on the 13th of June. You can use this as an entry going short. Well, look at it. Look what it did, Michael. It ran up here. Yeah, I know. But you're trading with a higher time premise, meaning you're entering here. Where's the model call for a stop loss? It's got to be above that high. If you're using the last up close candle, the same thing. You don't get short here, but you can be short here. The stop's got to be above here. We're not using the dollar index as a tradable vehicle. I'm just teaching the logic that you're applying to whatever market you're trading. Whether you're trading the breaker, which would have been a fill here or here, price alone, that's the instances where price returned to the PD array. Now here is where you separate the men from the boys and the lions from the sheep. Time. just because price went up to that level right there at 2 o'clock in the afternoon. Are you factoring a great deal of emphasis on a late afternoon dollar? No. You want to focus on the relationships of what the dollar's doing during key kill zones. Dollar is going to be highly sensitive to Forex. S&P, NASDAQ, Dow, it will use the longer term, higher time draw of risk on, risk off with the dollar. But sometimes, and this is where it makes it a little bit difficult for some of you, the index can flex against that. But you don't see that with euro and cable, unless dollar's being manipulated, held in consolidation, which it's not being here. It's being allowed to move, gyrate, move around. That means that your Forex pairs can be free to move around and have a lot more volatility as well. So if there's a emphasis on dollar usage in your analysis, just know that there is a much more impactful driver of price when you're using dollar when it comes to currencies. Longer term, yes, dollar risk on, risk off will eventually weigh on stocks, but stocks are also highly manipulated right now. They shouldn't even be at these levels. None of these companies should be trading at these multiples. It's ridiculous. But we have to stick with what the market's showing us if we were trying to make money. We're not trying to be predicting the crash, okay? I mean, in my opinion, the market should have crashed dozens of times, in the last 3 years. It should have, but it hasn't. And even though I know, and everybody with a common sense knows that these markets in stocks rather, they're not justified at the levels they're trading at. But are we going to sit around and arm wrestle what should be taking place from a practical sense versus what can we take as an opportunity? Because we have to trade what the market's giving us as opportunity. And that's what I'm teaching you to do. Focus on what is available based on time. Now, we have the market run up into during Wednesday at 2 o'clock. What is going on there on Wednesday? We had another market event that day, big calendar event, medium impact, high impact news drivers. We can anticipate on that weekly chart where the inception of the majority of manipulation will begin based on the calendar. So when we look at an economic calendar, we're looking at a medium impact or a high impact news driver, something that's going to be many times used as a smokescreen. I'm not of the opinion, I've never really had this opinion anyway, but I'm not of the opinion that because it's a high impact news event, that the market's moving based on that information. That is sometimes, in the way you could study this is go back through history and look at the releases of the data. I'm not a fundamental trader. Okay, I don't consider the information that's being released at the time. I never even refer to it. I never look at what the numbers were. I've done it in the past when I was teaching mentorship, just to prove to them that sometimes the data will come out, and from a classical perspective, the data may be perceived as good or bad. And if it's suggested in historical terms that whatever data that came out, if it's beneficiary or a positive for that currency or that market, but then how many times has the market rejected that and traded down, and then they come back after the fact and say, well, the market already priced that in. You weren't telling us that they already factored in that and priced it in. It's just an excuse because these things are being used as a smokescreen. So I just use a high impact or a medium impact news driver on the economic calendar to time, just like a TV guide. You know when time the game's going to come on, right? You go on there and you look on your TV and say, okay, the Knicks are playing today at this time or tonight at that time. The Super Bowl begins at this time on this channel. The markets are delivering price the same way. I know it sounds crazy. I know, but that's how I'm accurate. I'm following the schedule of when price is likely to move. And you can time when these market moves are going to occur, just simply looking at the economic calendar and blending in the key times of the day I've told you to focus on. All New York local time. So 2 o'clock on Wednesday. Where are we at here on Thursday? What time of day is this? London Open. London Open typically forms what? What did I teach? If you've been with me for a long time, between 2 o'clock and 5 o'clock in the morning, New York local time, London, generally 70% of the time, and for the folks that like to do these little number crunchings, I have people in the past say, well, that's bullshit. I went through the number. You're looking at every single week. You have to look at when the bias is suggested that we're going to entering a sell-off. Okay, if we're in a position, and I've told you on the 13th this week, I said that dollar's going to go here. We went there. Now your question is, you're like, well, how would you know that it wouldn't just reverse here and treat that as a long-term bullish order block? I know I just read your mind, right? You just dropped your potato chips, didn't you? Longer term perspective, we've already spent time reaching into premiums on that weekly chart for the dollar. We met multiple premium arrays as targets on the upside. And we've worked all of any inefficiencies out. And now we've worked into the discount arrays. So it's reasonable to anticipate that the dollar wants to go lower. We still have time. It's Friday. And everybody that sees this low here that went long, they're trying to catch the bottom. And that's why you're seeing what we're seeing here. We traded down into this low, deeper into the order block. What order block? Let's go back up to the daily for a second. This entire down close candle here, that range is the order block. If we're bearish, we want to see it trade initially into the open of it, because that's this change in the state of delivery. And then we want to see it try to reach for the mean threshold. How we know if it's going to continue going lower is how we close after hitting mean threshold. That's part of order block theory. If it closes below the mean threshold, chances are we're likely to see it want to continue going lower. If it were to go lower, we have a small little portion of this gap that's being shown from this candle's high and that candle's low. Looks like that. So that little gap right there, that's a small little area that's still exposed. So if we were to close below this middle of this candle that I'm highlighting here, that's the bullish order block. Wait a minute, you're calling it a bullish order block and you're calling it lower. Right. When it was up here earlier in the week, it was a discount array, but it's classified as a bullish order block. Again, bullish order blocks are not always buying opportunities. They're targets and are also means of measuring order flow. If we close below the mean threshold, half of that candle's body, if it closes below that, it is indicating that it might want to still keep going lower into next week. And if it does, where would it reach for? Sell side below this candle's low. Let me move it out of the way, I'm sorry. Below that candle's low and into that small little inefficiency. And if it accelerates, we have another fair value gap right here. The candle I'm pointing to is a fair value gap in the form of a buy side imbalance, sell side inefficiency. Look at the candle to the left of the one I'm highlighting here. That candle's high to the left and the candle's low to the right. That makes this a fair value gap. I don't know what we're going to do over the weekend. This is why I don't trade on the weekend. I used to trade over the weekend. I used to hold positions over, but because of the gap risk, what does that mean? Where we close on Fridays and where we open up on Sunday can be dramatic now because of all the things that's been going on over the last 3 years, and we're not going to talk about all those topics, but the nonsense that's been going on all around the world, all the geopolitical things and health and welfare issues that everyone's having to deal with, they have caused a great deal of gap risk. So most of your trading, in my opinion, should be settled intraday. Unless you're really, comfortable with gap risk, even the restart at 6 p.m. when there's a lull in trading, for 5 o'clock to 6 o'clock if you're trading stock indices, sometimes those gaps can be a little bit jarring and it can be a little bit more than you anticipated. Sometimes it's in positive, but sometimes it can be in negative. So I think if there's ever been a time in history where traders should be primarily focused on day trading, we're in it. This is the climate for that, to be sleeping soundly at night. So anyway, I covered a lot here, and I'm going to go lower time frame. We're going to go to a 15-minute candlestick chart. And we're going to take a 10-minute pause here. So right now at the time it's 9:53. I went a little bit longer than the hour. I apologize, but that's typical ICT. I always over deliver. Let's come back exactly at 10 o'clock. It's not quite 10 minutes, but let's take a break. You can go relieve yourself, refresh your drinks, and go tell your wife and husband that you're learning something and you can't wait to get back to it. So I'll see you in a few minutes. All right, folks. I'm checking Twitter before I start talking. I want to make sure that you can hear me. We've taken a couple minutes break. If you guys can hear me, just give me a 5x5. That audio is back. Again, just checking to see if Twitter can confirm you can hear me. Thank you, Emmanuel. Thank you, folks. Appreciate that. All right, so usually I like to ask you all to give it a thumbs up and such, but if you like what you're learning here today, and we're not even close to being done, just give this a like. It doesn't cost you anything to do it. Just a little quick little thumb. You're going to want to use this as a marker to go into your liked videos to find this one. I promise there's a whole lot of stuff in here you're going to enjoy. All right, so back to the discussion. We have just made our way into the 15-minute candlestick chart for the dollar index. So obviously I'm taking you through a very detailed top-down analysis of what it is that you look for whenever I talk about where I think the market's going to draw to. That's my experience in 3 decades of knowing what I've seen over the years, what the algorithm is likely to be doing. Unless manual intervention steps in, these are the things that we expect to see. And that's what makes what I teach and what I share and what I call in advance so accurate. A lot of people that have odds against me because they're running a service, paying paid service, something they're selling or whatever, they'll say what I do is easy. Anybody can do it, but they're not anywhere near as accurate. They don't call the levels to the degree. They don't have the experience I'm sharing with you. And all I'm saying is if you listen to other people and you haven't spent time here seeing what it is that's being shared and taught, you really aren't making an informed decision. You're just using someone else's opinion, and that's the mistake, or I guess trap of social media. So with that said, let's get into the nitty gritty here. All right, so we have the dollar index on the 15-minute time frame. We've been talking about this weekly inefficiency. That was a weekly inversion fair value gap. I stated on the 13th of June 2023 that we would look for signatures that this is being utilized by the algorithm for resistance. Now, when we look at the dollar for Forex traders, you're really going to be focusing on like the London open kill zone, the New York open kill zone. And again, for the London open kill zone, it's all New York local time. It begins at 2 a.m. and ends at 5 a.m. Now, I personally, I use 1 a.m. as a buffer. And to me, that kind of like cancels out any tomfoolery that would occur because of daylight savings time, which I wish they would abolish it. I mean, it was the stupidest thing to implement anyway. In some parts of the world, they don't even use daylight savings time. But to remove all the uncertainty about time, I've always used, my personal is 1 a.m. to 5 a.m. Okay, that's the time. So that means any setup that I like to look for can occur that early, which is kind of like the European Open. And then you have at 2 o'clock, it's the London Open at 2, and it usually closes up shop and the volume peters off at 5 a.m. And in between 5 o'clock in the morning to 7 o'clock in the morning, I refer to that as dead time. Don't try to do too much anything in here. But I have taken trades as early as 6 o'clock in the morning, trading the New York session or the New York open kill zone, which is classically defined by 7 o'clock in the morning to 10 o'clock in the morning. And you can look at 7 o'clock to 9 o'clock as that little sweet spot where the majority of your trades are going to form buy or sell for Forex trading between 7 o'clock in the morning and 9 o'clock in the morning. The London Open, I talked about this moments before we took our first break. At 7 o'clock, at London Open at 2 o'clock in the morning and 5 o'clock in the morning, New York local time, that is the ICT London Open Kill Zone that if you know where the weekly candlestick is likely to draw to, everything I've been talking about up to this point, is how I do it. There is no shortcut version of it. It's just the market's going to go up to a gap, or it's going to go up to an old high. If it's going to go up, if it's going to go down, it's going to go down to a gap below price or go below an old low. That's it. How you define which one it is what has it done recently? How has it traded? Is it leaving a range that we've worked multiple times back and forth and it's been efficiently delivered, and we left that range? Chances are it's probably going to expand lower, reaching for an old low or inefficiency in the form of a fair value gap below price, or reverse it. I mean, it's that simple. And what you're wrestling with is you're trying to bring other things that you either know you learned from somebody else, some kind of other indicator-based idea or retail perspective, maybe supply and demand, maybe Elliott wave, maybe harmonic stuff. You're trying to bring that into this and see where you can help your understanding by bringing that in. And that's the mistake. Leave all that stuff at the door. Like, what I'm teaching is not complicated. It's either going up or it's going down for one of two reasons. And if you spend the time on the weekly chart to define that, you can come away with what I've shared many times for years in the witness of hundreds of thousands of people. And they're watching it pan out. And if you're new, you're now just discovering it. And I envy you, because I know what it was like when I first discovered it. It's crazy. It literally is mind-boggling to see how much precision and everything is scheduled. Like, every price run that you see in price action is not a surprise, unless it's a wartime event or some kind of event that would be destructive. We'll say it like that, or a manual intervention coming in like a surprise rate announcement. It's happened. Those things I'm not prepared for, and because of that, it incurs risk, and that's why you have to always understand that. As good as my stuff is, and as good as anybody else's stuff might be, and people can show profitability and show statements and show live streams, and they can do this and do that, it does not change the fact that any one of us, me, somebody else that's teaching, selling courses, or whatever, any one of us can be a victim of some unexpected event that can completely take everybody by surprise. And I use the analogy many times with the depegging of euro and the Swiss franc, where brokerage firms immediately were made insolvent, and people lost their money. They lost money. Billions and billions of dollars were lost that day because of that depegging between the euro and the Swissy. So, did anybody see that coming? Did anybody warn you in advance about that stuff? Chances are probably not. So that's real risk, and all of these markets have that kind of risk. So, is it something to be mindful of? Yes. Is it something that paralyzes you and never, allow you to go in and trade? Well, that's up for you to decide. Okay. I don't tell people to trade with live money. You'll determine when you're comfortable doing that. I don't ever sit down and say, you're ready to do it now. But I know the ones that aren't. So if you look at the range here, we're going to measure the high. I'm trying to find a point where I can lay it on the low. Okay. So we can see that the highest point here, and it might not be the very pipette, I could care less about that, but the low and the high, I've dropped the Fibonacci on that. And the only thing I'm using the Fibonacci for is to show you the relationship of the three specific price levels that I teach my students to look at. So if we're looking at the high, okay, I'm trying to see what that number is here. Okay, 103.445. The low, 103.226. Okay, they may or may not be the actual high and low of the weekly candles that are used to define that range, but I think this is close enough for government work. So the midpoint is 103.336. The midpoint of any gap, that being a fair value gap or a real liquidity void. A liquidity void would be like this little area right there. See, there's no overlapping of any wick or candle body. It opened here and it closed here. There's no price data here at all. That's a real liquidity void. That's a real gap. We refer to things like this here as a fair value gap, and this would be in the form of a buy side imbalance, sell side inefficiency. This is a real liquidity void. Any gap, whether it be liquidity void or inefficiency, or like I have it shaded here up here, they're measured from the highest high and the lowest low of that respective inefficiency or gap. And the midpoint is always referred to as consequent encroachment, meaning that as it starts to fill in and reprice to the high or low of these levels, as it encroaches, it's most likely to refer to the midpoint of the gap or inefficiency than the extreme high or the low. And that's the basis of why we like to see, if we're bearish, we want to see the upper end of the inefficiency or gap respected and treated as a premium and not be dug into. Meaning, as I mentioned before we took our break, we don't want to see the high end of any inefficiency be retraded to if we're bearish. If the market is really, in fact, in a sell model, the best ones, the strongest delivering obvious runners, will always have this signature hallmark part to it where the upper portion of it doesn't get traded to. Look at the bodies of the candles. We have just a little bit of movement above it here, but look at these right there, right on that midpoint of that. You think that's random? When I talked about it on the 13th of June in that live stream, I said, I want to see, does this show signatures in price action that confirms, it suggests that my assumptions, by anticipating this level that's shaded in a pale orange, that would be treated as resistance or a means of beginning short trades for smart money. And in targeting this level down here, which is the bullish order block on the daily chart. So in your mind, as a trader going forward, whenever I say things like that, or I say, I'm looking at this as a premium array, I want to see it be treated as a resistance and then enter a sell program, and I point to where I think it's going to go. Right away, in your mind, you start thinking, okay, he just told me where he believes with 30 years of experience, where it's likely to go. So I just told you bias. I cut through all the bullshit. I got right to the point. If I sat down with you and taught you every single week what I'm doing, you like, first of all, I would never get that. We're still in dollar. We just finally made our way into the 15-minute chart. It does not take you this long to do the analysis, but it does take me this long, and as long as it's going to take today, for me to teach you what it is that's going on in my mind to make the decisions to tell you before it happens, and it happens in your chart later on perfectly. You want to know. You show up. You want to ask me these questions, and I'm giving you the answers. Don't bitch at how long it takes me to give it to you, because it's not an easy, and then you get the information. Like, you have to weigh out a lot of things, which it's not an easy 1, 2, 3 program. There is no easy 1, 2, 3 precision out there outside of this. There's things you can make money with, but you're never going to come to the conclusion that I'm showing you as consistent as I am with anything else. This is the market. So when you hear me talk about in a tweet or a Twitter space, or if I share the analysis on a presentation, whether it be live streamed or a recorded review, and I give you an opinion about what I think it's going to do next, that's the time when you start paying attention the most. Okay? You want to say, all right, he anticipates me, ICT's, telling you that we're expecting